On the budge, we can go.
Okay, welcome everyone. My name is Nikki Johnston. I'm with Transition Advisors. Our webinar today is how to value your firm when selling externally or to your partners. Before we begin, we need to cover a few very important items. First, please close any other programs that you have on your computer. This will help to ensure quality presentation and reduce any audio issues that may come up. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your 1 CPE credit for today's webinar, you must complete 2 requirements. The first is that you must participate in all 3 of the polling questions throughout the presentation. And please note that GoToWebinar does monitor your participation in these polls. Next, a link to an evaluation will be emailed to you later this afternoon. That will come from me. That evaluation must be completed before we can email your CPE certificate of completion. Once these requirements are met, then I will send you your certificate, and you'll receive that within 10 working days. Additionally, at the end of the webinar, a very brief survey will pop up, and that will appear immediately in your browser. So please take a minute before closing your browser to complete it. That survey is very important to us. It helps us provide information, gets your suggestions for some future topics, etc. In order for you to fully participate in the webinar, please familiarize yourself with the GoToWebinar control panel. It should be on the right side of your screen. There's an orange arrow on the top, and that is to minimize the panel. During the presentation, everyone is muted, but you can communicate with us by using the question box, which is toward the bottom of that panel. Just type your question in the box and click send. We'll hold the questions until the end of the presentation, and then Joel will answer them as time allows. Finally, I'd like to remind everyone that Transition Advisors offers a free 1-hour CPE webinar each month. Our upcoming topics include new practice niches, internal succession, and avoiding merger roadblocks. You can see the dates and the full titles there, and a complete list of webinars, including the links to register, is found on our website in the CPE courses section. So with all of that said, we're going to go ahead and do the first polling question for today. Remember that these do need to be completed in order to receive your CPE credit. So the first one's pretty simple, multiple choice question here. And the question is, how many partners are in your firm? So just take a moment here. It's either 1 to 2, 3 to 8, 9 to 20, or 21 plus. And I'll give everyone just about a minute in order to complete.
If you're all going to have to listen to my New York nasally sound, you might as well get CPE out of it. So don't forget to fill out your polling questions.
Okay, it looks like nearly everyone has completed. Just one more moment here, and then we'll close the poll. Okay, that first poll is closed. And with that, I would like to introduce our presenter for today's session. Joel Sinkin is the president of Transition Advisors. I thank you all for joining us and hope you enjoy the webinar.
Thank you very much, Nikki. I'm waiting for that little button that says show my screen, and there it is. And welcome, everybody. For those of you who have heard me speak before, I am still Freddie, and welcome back to Elm Street. My name is Joel Sinkin. I'm the president of Transition Advisors, and today we're going to spend the next hour talking about how to value an accounting practice. This is both when we're selling it externally to an external buyer, and we'll spend some time, not quite as much, but some time on how to value it when selling to a partner. You know, I never treat a CPE event as an infomercial for the company, but I always think it's important to understand the perspective of this. For the last 24 years, the only thing I've done is help accounting firms buy, sell, and merge with each other. I'm the succession advisor to the AICPA, wrote over 100 articles, books, and case studies. This is all we do, and fortunately, we're talking to you in 2013, because in 1990, we weren't the sharpest tools on the shed. And all those mistakes that we saw and we've tried not to make the same mistake twice. So today, hopefully we'll be able to put you on the path to avoid some of these roadblocks. These are just some of our team members. I'm going to skip through it. Hopefully a lot of you recognize some of us, and Terry, Bill, and I, Mark Bazinski. We're all over the country. It's all good. Let's talk about CPE and why we're here. I always start every CPE event by, if there's 50 things you need to know about what we're discussing today about valuing a firm, the smartest person in the room is going to think of 35. We're not going to get you to 50 today. The reality is, an accounting firm is an incredibly unique business. I could show you 10 practices with the same amount of volume, same amount of partners. You'll have 10 different nets, 10 different cultures, 10 different relationships between the staff and the owners, between the owners and the clients. Suffice it to say, though, there are parameters that things operate. So today we're going to get you into the 40s of those 50 things you need to know, but we're not going to be able to get you all the way. Let's start a little bit by talking about what's going on out there. I happen to write for the Journal of Accountancy and Accounting Today and a lot of publications, and you don't get one newsletter, you don't get one print magazine that doesn't talk about buying, selling, and merging accounting firms. So what the heck's going on out there? Well, first of all, in 2006 through 2008, accounting firms were having such fantastic organic growth that the emphasis was on staff. People couldn't get the staff to get the work out. They had the work. But then the economy dropped. And although we see signs of it coming back, you can't take clients. So what happens is when organic growth gets stymied, M&A growth becomes much more appealing. A lot of merger and acquisition has been pushed by the concept of cross-selling services and developing marketable niches. Obviously, we're limited in how we can grow a firm. If we're going to be able to bring an additional service to the table, we're hoping that will generate additional revenues. But the biggest driving factor by far and away right now in the accounting industry is the aging of the baby boomers. 80% of the 40 to 60 deals we touch a year, 80% or more relate to succession for one or more partners. We're at that point in time where every 60 seconds or something like that, another accountant turns 65. So this has changed the market. So before we start talking about value, let's address something that I get asked regularly. Is it a buyer or seller's marketplace? If there's that many baby boomers, if there's this much activity, how has that impacted the marketplace? Let's start with the following. If you're a small firm and you're in a densely populated part of the country, the good news is it always has been, likely always will be, a seller's market for you. Now, it's not the seller market of the early 1990s when 1.5, even 2 times was the rule of thumb. No doubt values are less in 2013, and each year for the last few years they've crept down a little bit. But the demand is substantial. If you look at a place like Nassau County, New York, there are 3,000 accounting firms there. So when you're a small firm in a densely populated part of the country and you say, hey, I've got $500,000, $1 million of repetitive business and I'm ready to give it up, there's usually a great audience for it. Number one, so many accounting trends and topics relate around the top 100. There's 45,000 firms that are members of the AIA. You take away the top 100, we have the other 44,900. Most of which are 1- and 2-partner firms. And smaller volumes, not only are there a larger group within that volume, but you can absorb a $300,000 practice into a successor firm with little to no incremental increases in overhead. When you're taking on a $30 million firm, it's not so easy. So if you're a small firm in a densely populated part of the country, there's a great demand typically for your firm. If you're a small firm and you're in a remote area, let's say I'm 3 hours outside of Boise, Idaho, I may be in absolute God's country. But if there's one accountant for every 3 or 4 zip codes, supply and demand takes over. And unfortunately in those areas, it's a very strong buyer marketplace. The firm that's in trouble, the firm that's changed the most, is the small regional firm. Let's look at an example like Boston. Boston has over 40 firms between 3 and 8 million in the greater metropolitan area. But there are only 4 firms large enough that are independents to be their successors. So of these 44 firms, most of which probably think they have the talent on the bench to execute an internal succession plan, most of them will find out they don't. And all at once, they'll all start looking for that solution. They're already now pounding the streets looking for the ultimate commodity in accounting, young talent with a book of business to shore up your internal succession team, but that needle in the haystack very few find. So what's going to happen, and is already happening, is when you have 44 firms, half of which will probably have to look for a solution to their succession and therefore look to merge up. There's only 4 successors. It becomes very the buyer's marketplace. So depending on size, depending on location, changes whether or not you're a buyer or a seller's marketplace. What helps you, though, if you're selling, is a buyer only has 3 ways to grow. 1 client at a time, which in a good economy works, in a bad economy treads water. Develop cross-selling opportunities by having a niche. Or the only way to grow overnight is through a merger or an acquisition. So the market, if you're in a reasonable area of the country, density of population-wise, should work to your favor. Again, not the same values there were, but there's value there. Most of the time, an accounting practice is sold based on a multiple of billings. Occasionally, there's a fixed valuation, fixed as a multiple, fixed, for example, in many internal sales based on a multiple of compensation, not revenue. But most of these firms are done in this manner, where it's full of billings. But how do we get there? That's what we're going to be discussing now. Let's start by understanding how most succession deals get structured. The structure will impact to a certain degree value. But let's start most frequent deal structures that we see as it comes to a sale, internal sale of an accounting firm. The first one I call it sale. I'm not suggesting that I get a call May 1st, someone says I'm selling my practice, and June 1st they're in Boca Raton. What I mean by a straight sale is the owners are not looking to stay on full-time. Hopefully they're looking to stay on and conduct a proper transition, mind you, but they're not looking to become equity partners of the successor firm. They're not looking to maintain their income and control. They're looking at a sale. A buy-in to buy-out is an interesting concept. Here's an example of how it works. Let's say that Nikki has an $800,000 practice and I have a $200,000 firm. Well, when we merge together, the new firm's $1 million. For me to be a 50% equity partner, I needed to own $500,000, but I only came in the door with $200,000. So initially, I do a buy-in. I buy $300,000 of revenue with a payout period traditionally, and then 3 years later, Nikki wants to retire. I buy her out. A buy-in to a buy-out. Most of the time, it involves a combination of the entire practices. But in that same example I just gave you, Nikki might have said to me, Joel, I'm looking to get out in 3 years. I really don't want to be a partner in your business, but I'm okay with you being a partner in mine. In which case, instead of me bringing my clients with me, I keep them in a second entity, and I buy in $400,000 of her $800,000 with a buyout. Buy-in to a buyout. A merger to a buyout can be very similarly, except there's no initial buy-in. So in that example before, if Nikki was 800 and I was 200, the new firm's $1 million in revenues. I'm a 20% equity partner. Nikki's an 80%. When she goes to retire, I'm buying out 80%. I already 80%. Mergers to buyout, that's an overly simple example. Obviously, it could be a $2 million firm merging into a $10 million firm, but they're not, the $2 million firm's partners aren't retiring for 6, 7, 8 years or longer, so it's a merger that leads to a buyout. An interesting thing that's becoming more and more frequently seen is something I call a cull-out sale or a carve-out sale. And there's several different examples of how they may work. There's 3 main types of deal structures that revolve around the concept of a cull-out sale. The first one could be a niche. Here's a great example. We had a firm in our Philadelphia office about 3 months ago. They loved wealth management, hated the accounting world, but they kept their accounting firm because to them it was the stepping stone that got them the wealth management business. So they attended an event that I was teaching at for the AICPA, and they heard this exact story. What they ended up doing was we introduced them to a firm that didn't do wealth management, but was very strong in high net worth individuals. The accounting firm acquired the compliance side of that of the seller's practice. They bought the accounting and tax side. The buyer signed a non-compete, though, in wealth management. The seller signed a non-compete as it related to the accounting work, but retained the right to do the wealth management. So that when we closed the deal, the seller actually physically moved in with the buyer. And the letter we sent out to the client base basically said, hey, I can't be on top of the day-to-day changes in the tax laws and the constant ever-changing environment of the stock market and all your financial needs. So I've merged with John and Jane Doe. They're going to focus on the accounting side. I'm going to focus on the planning side. Held it out as a merger of niches. Literally, they share space together. They refer business to each other. That's a cull-out. They culled out a portion of the practice to retain and sold the rest. I've seen it done many times with niches, litigation support, what have you, and I've had larger firms sell off their niche that they decided no longer to keep. Another example of a cull-out sale was in our California office last year. There was a gentleman, two-partner firm that owned, it was a small firm, about $1.2 million. They had $100,000 worth of clients that they just felt very personal, very comfortable, loved doing the work for them. They culled that $100,000 out. They sold all of their practice except for those clients, which they retained the right to service, and by the way, gave the buyer first right of refusal to buy them at a latter date. So sometimes a cull-out sale could be a stepping stone to succession where the seller retains certain clients because of passion, because of income, and gets rid of the rest. The third type of cull-out sale that I've seen is really for firms that are struggling with internal succession. An example down in our Florida office a couple of months ago on a retreat we did for a firm. They were a $3 million firm. They had 4 partners, one of which wanted to slow down in 2 years, one in 4 years. And they're looking on their bench. They felt they had nobody that could step up to become a partner. And they had tried for 2 years to develop talent, to merge in, find young talent, unsuccessfully. They were dead against the idea of merging into a larger firm, even though that would have been a viable solution. So what did they do? They looked at the old rule that the 20% of the clients that pay the lowest fees take up at least 50% of your time. So they took their basement of their practice, about $400,000 worth of clients, and they culled them out. And they reached out to a smaller firm who looked at those clients as their ceiling. Remember, your basement clients are somebody else's ceiling and vice versa. So instead of just firing those clients, they put those clients in someone's hands who really wanted them, and they got paid for it. And by getting rid of those clients, they created the capacity they need to be able to execute an internal succession plan, a carve-out sale. But by far the most frequent structured deal that we're involved in is a 2-stage deal. A 2-stage deal is designed for practitioners who are 5 years or less from reducing their time commitment to the practice, but didn't want to give up their control or income. It's based on the concept that 99% of your clients, especially in your small firms, have no idea if you're competent or incompetent as an accounting firm. If they knew that much to measure your technical skills, why are they paying you to do the work they understand so completely? Unless, of course, there's a test involved that they cannot do for themselves. So why do you have your clients? It's because of you. In 1990, when I started, most accounting firms went out to see their clients every month or quarter. But in 2013, 87% of our clients we only see once a year. They're on the cloud, portals, staff goes out, email picks them up. We communicate with them regularly, but not face-to-face. So when someone's 3 years from slowing down, not necessarily retiring, but slowing down, it's only 3 visits. And the 13th Amendment prevents slavery. You can't buy and sell people. So you need to have a transition plan. But nobody did it because they didn't want to give up control. Here's a 2-stage deal. In our Chicago office just a couple of weeks ago, we had a small firm, 500 and some odd thousand in revenue. The seller was netting 40%, including perks, benefits, probably the kid's cell phone. They were operating with 1 senior, 1 paraprofessional, and a per diem. Here's how the deal worked. They said to this gentleman he wanted to work 3 more years full-time and then multiple years part-time. They said, Mark, come in with us. Right now you're making 40% of what comes in. I'll continue to pay you 40% of what comes in. And I'll hire your entity as a consultant. So by paying the dollars to your entity, you can continue to have the entity pay your car lease and your medical and retirement and whatever you'd like it to do. We'll take over all of the overhead and we'll supply you with the same amount of labor you used in the past. So for the next 3 years, the successor firm was going to do the billings, taking over a lot of administration, getting to meet the clients. The seller was being kept whole in income. There's really only 2 ways Mark can make less money over the next 3 years. One is if his fees go down. But let's remember, for example, in Mark's case, his largest client is a wholesaler that he does $50,000 a year with. If he loses that client today, he loses $50,000 of income. He can't fire anybody. His rent's the same. Now in a 2-stage deal, he loses that client, he only loses 40%. The other way he could make less money is if he suddenly needed more labor than he used in the past. But if he doesn't do a deal and needs more labor, he has to pay for it. So this firm said to him, hey, we'll give you the same amount of support you have. If you need more, which likely only means he decided to slow down, we'll supply it and we'll charge you some sort of fee that covers our costs for the labor we supplied you. So for the next 3 years, Mark comes and goes as he sees fit. He has autonomy, control, and income, same income. He's doing a great transition. God forbid he gets hit by the bus. There's an acceleration to stage 2. And on the first of the following events, in his particular deal, the end of 3 years, God forbid a health reason, we go to stage 2. Stage 2 is the buyout. See, I can't keep you whole in income and pay you for your equity at the same time. So by deferring one for the other, you can maximize both. Why did the successor firm do it? Because in those 3 years, they saved over $100,000 in overhead each year between the savings in rent, software. They didn't need the para or the per diem. They had the capacity to provide that labor to the seller. They just kept the professional. Buyer made more money. Seller kept control, independence, autonomy, income. Then stage 2, the buyout. Now envision a 4-partner firm. One partner wants to retire right away. He gets a straight sale. One partner wants to work 3 more years and then slow down. He gets a 2-stage deal. The other 2 are only 40 years old. They exchange equity in their firm for equity in the successor firm. They do a merger. By understanding these different deal structures, it enables you to allow each partner the independence to decide their own sunset or horizon of when they want to slow down. Structure one deal with one firm that customizes each of the partners' goals. So we've discussed all these preliminary things, but whenever I teach this class, there's 3 main questions everybody has. The first one is, what is the multiple? The second one is, what is the multiple? And you guessed it, the third one is, what is the multiple? So we have over 160 people on the phone. Let's talk about what is the multiple. What I want to share with you all is that multiple is the effect. As good business people, we need to focus on the cause. So I'm going to walk you through the 5 main variables I look at when valuing a small firm for an external sale. Now, if any of you on the phone are one of those 8 people that purchased the book I wrote 15, 20 years ago that talked about how to value a practice that PPC published, and I had 11 variables in that book. Keep in mind I was paid by the page. There's really only 5. Don't hate me. And by the way, thank you if you're one of those 8 who bought the book. So let's look at what are these 5 variables, and this is not necessarily in a sequence of order. But the first one we're going to talk about is cash up front, if any. And as you notice, I have a little notation there, 2013 impact. That impact has been a considerable reduction in the amount of money you traditionally see up front in most accounting firm deals. I know most of you were hoping to hear something otherwise if you're thinking about a sale, but for me, the range of down payments that I've seen in the hundreds and hundreds of deals we've done has been 0 to 20%, the highest percentage at 10%, and more at 0 than over 10%. But money up front in 2013 has a lot of different reasons that the economy's impacted it. One of the reasons is banks have cut back dramatically on their loans. Firms have used up a lot of their lines of credit. But a hidden reason for it is accounts receivable. There's very few firms that haven't told me that their accounts receivable are slower than it's been in a long time. Well, if my receivables as the successor firm are slow, that puts me in a cash poorer position. And now I'm acquiring a firm, and if that firm's receivables are slow, I might be having to carry that operation for months and months before I start collecting new money. So that has put an additional burden on the buyer. So the economy has an impact. Time of year has an impact. If I have a small $400,000 practice, and by April 15th I've billed out 75% of it, and I'm closing my deal in May, I clearly cannot expect the same amount of down payment as I might have gotten in January. Now, that's certainly not a reason that someone should wait 8 months before they sell their practice. It's just the reality of cash flow. If you're a very heavy tax season practice, and we're closing shortly thereafter, we might be asking the buyer to literally carry the overhead at a loss for 10, 11 months. So it's very challenging to get a big down payment. So the deal's cash flow, how quickly can I get a return on my investment, is going to impact my ability or my willingness to come up with a certain amount of money at closing. Again, with the treatments of accounts receivable, sometimes I've seen people say, hey, I'll give you this much money up front, but I'd like to have a 1-year payback period on your receivables, because it's hard to do both. It's hard to give you the 10% down and then have to cover 4, 5, 6 months of overhead before I'm in cash flow. So there's a relationship between them all. The bottom line, again, how quickly can I recover that investment? That also, by the way, can include technology. There's a firm that we're working with right now in the Maryland area that's so woefully, woefully behind in technology. The owner of the practice does not have a computer on their desk. You walk in, there's files knee-high everywhere you look, one monitor on the people's desks who do have a computer. So they're not paperless, they're not multiple screens, they're not on the cloud. The anticipated cost in bringing this firm into the successor firm, which is a 21-person firm, is $8,500 per employee to get the training, the technology, and everything back onto the same platform, plus a learning curve. So that firm the successor firm, was not very excited about putting a lot of down payment money up because they had to make a significant investment in technology to get that firm onto the same platform. So as you can see, cash up front is not just based on the depth of one's pocketbook. Time of year, how we're going to treat accounts receivable, how quickly we could recover it, are all parts of cash up front, if any. Perhaps important of the 5 variables to many people is the retention clause, the guarantee period. What we're specifically referring to there is how long after closing will a loss of the client or a fee increase, for that matter, impact the balance due the buyer owes the seller. That's your retention period. Now, there are multiple different ways that you see retention period work. the first on our hit list on the PowerPoint on your screen, talks about deals by collections. Some people call it an earn-out deal. So in an earn-out deal, if the multiple is 1 time, just to pick a number out of the sky, don't get too crazy, that's what they all go for, over 5 years, we're saying the purchase price is going to be 20% of collections for 5 years. That's a collection deal. A collection deal, the entire payout period is the retention period. Because for all, in this case, 5 years, we have to collect the fees in order to owe any money. That's a collection-oriented deal. The entire payout period is a retention period. Now, by the way, this doesn't mean there's not money up front. We had a deal closed very recently in our Detroit office, small firm, about $800,000, $900,000. They got, I think it was $75,000 up front, 22% of collections for 5 years, less 50% of the down payment in year 1 and 50% in year 2. So a collection deal doesn't say that means you get no money up front. It just means if you get money up front, it has to be credited back. A fixed deal is a very rare deal in an outside sale. That's where day 1 there is no retention period. I can tell you, as someone who's consulted on over 900 closings of accounting firms over 25 years, on an external sale, I've consulted on 2 of those. That's how rare a fixed guaranteed purchase price is day 1. More often than anything in the country are what we might call a limited retention period. That's where the seller might say to you, hey, whatever you do in year 1 or year 2 locks my purchase price. So therefore, there's a reasonable adjustment period based on client retention, and at the end of that period of time, the purchase price locks. What's kind of interesting and very counterintuitive is what's the best of those deals for the buyer? What's the best of those deals for the seller? And conversely, what's the worst? I'm just about finished reviewing 99 different deals for a paper that we're doing for the AICPA that analyzes who won, who lost on these deals. And let me tell you that the information and the research has been overwhelming, that even though we're not ready to print it yet, I can share with you the results. The worst deal for the seller turned out to be the 1-year guarantee deal. So here the seller was saying to themselves, I need to protect myself. I don't want to be in a position that people are screwing up and losing clients, so I'm going to have the shortest retention period I can get, 1 year. Well, let me tell you what the buyer's mindset was. First, the buyer tells, why doesn't this person have any faith in their clients? It put them on the back of their heels. What a lot of you didn't realize when you sat for your CPA exam, there was this special chemical that they put in the cushions of all the chairs you sat in. It all went up, that chemical went up your you-know-whats and made you all real conservative. I don't have a lot of CPA firms that tell me what's going to go right with things, but I have a lot that tell me that's going to go wrong with it. So when a seller says to a buyer it's a 1-year guarantee, many buyers envision Moses parting the Red Sea and taking all the clients away from them in month 13. So what does the buyer do? The first thing they do is dramatically reduce the offer they would have made because of this imputed greater risk factor. The second thing a smart buyer will do is shake the tree real hard during that first year. You don't want to lose a client in month 15. You could have lost in month 5. So the seller ended up getting a lower multiple, locked in at the lowest point in time of revenue the firm was going to do from a buyer who was the least patient in the transition. Again, counterintuitively, the best deal for the buyer so far has proven to be the 2-year retention period, not the collection deal. And here's the theory. And by the way, for those of you who are still thinking about a 2-stage deal, the retention period doesn't start until stage 2 in a 2-stage deal. But at any rate, the reason that the 2-year guarantee deal works so well for the buyer is, if you acquired my practice today, if you handle the clients in 2014 without me, if they come back in 2015, they're yours. See, the true measure of client retention is year 2, after the change was made, because they made a conscious decision to come back to you. So what a lot of buyers were able to do was to shake out over those 2 years who wasn't going to make it, but yet stop the seller from participating in the fee increases and special projects that traditionally got created after year 2. If I kept them in year 2, what's more likely in years 3, 4, and 5? Losing the clients or increases in fees, special projects, things like that? Now, the exception to that was the practice that has one or more 10,000-pound gorillas in it. So if I have a $500,000 practice and I have 2 clients that between them I do $150,000 with, I might have insisted that those 2 clients stay on an earn-out or collection basis, and the rest goes on a 2-year guarantee period because of the obviously inherent risks of a practice that has that much revenue tied up with those few clients. The best deal for the seller turned out to be a collection deal. Buyers were willing to offer a premium as much as 0.25 in many deals more, for the opportunity to remove the risk. Because they didn't have the risk, they were ready to offer a premium. They were much more patient in the transition of the practice because they were not at risk. And most of the time, just as I alluded to a moment ago, years 3 and 4 and 5 saw significant growth. And I'm personally against a collection deal where the buyer says to the seller, hey, if I lose this client, I don't have to pay anymore. Oh, by the way, if the fee goes up, you don't get that either. What really should be in a collection deal is the seller's participating on the downside, they bloody well should participate on the upside. What was, well, instead of getting one time, someone got 1.2 or 1.25, how many clients would they have had to lose to get back to where they would have been? Then add all the fee increases in special projects. Sellers came out ahead financially based on a collection deal compared to any other deal. Now, to end this whole retention aspect, there's something there on your screen called an economy clause. In some of the limited retention deals, especially in 2010 and 11 and 12, when a lot of paranoia about clients going out of business, there were a lot of economy clauses in deals where, let's say, for example, we agreed on a 2-year retention period. If in year 3 a client was lost to another accounting firm, there'd be no adjustment. But if in year 3 that client was lost because they no longer needed the services of an accountant, they went out of business, died, relocated, sold, there'd be some sort of an additional adjustment. So one's a full guarantee, one's kind of a limited guarantee. So variable number 1 is cash up front, if any. Variable number 2 is the duration of the retention period. Before I go on, Nikki, let's get out that second polling question so I can get to the rest of these variables.
Okay, sure. The second polling question is on your screen right now. Which best describes your situation? And your options are, we're looking into a merger for growth, we're looking into a merger for short or long duration, we're looking into a merger that combines the above, or we plan on remaining the same. So take just a moment here to read through the options and select the one that applies to you. Keep in mind you do need to complete the polling questions in order to get the CPE credit.
I guess people are just enjoying hearing me. They don't need the credit, and that's okay too.
Just a few more seconds. It looks like nearly everyone has cast their poll, but we'll just wait one more minute for those last few folks.
Okay. And then on to variable number 3.
Okay, go ahead, Joel.
Thank you. Variable number 3, the most confusing one of them all, profitability. And the reason I say it's confusing is because I am not referring to the seller's profitability. The seller's profitability is almost irrelevant to me. I'm talking about the buyer's profitability. And let me give you an example of how that illustrates this. Let's say that 5 years ago I had a small $300,000 compilation tax practice. I operated out of my home. My wife, Kathy, answered the phone. What was my net? 85%? But then we were tired of people knocking on the door, so I took an office. Kathy didn't come with me. I hired a secretary. And I decided to play golf on Wednesdays with the dentist and hired a per diem. And now I'm 9%. And was my practice worth more to you? It's irrelevant. You see, what's relevant is if you could have absorbed my practice with no incremental increases in overhead, it's a very profitable acquisition. If I say you have to keep my lease, you have to keep my office manager, 85 grand and has 16 weeks paid vacation, but you have to keep her. All of those types of must-haves do what? They mitigate profit. So the value that I'm referring to of the five variables when it comes to profitability is the profitability of the deal. Now take that same concept, by the way, to billing rates. Many times you look at a billing rate and make a decision on a piece of paper. Great example, last year in Texas, we had a $2 million firm. No managers, no seniors, no juniors. Whole bunch of paras, clericals, and 2 owners. They were only doing $1 million. I think I said $2 million, excuse me. And one of the problems that the successor firm initially brought up to me was they said, look, those partners are only getting $200 an hour. We get $350. How can we do this deal? And I asked that firm, when you bring this practice into your world, who's going to do the work? They said, what do you mean? I said, they don't have managers, seniors, juniors. You do. How are you going to leverage that work? They said 85% of the work those partners are doing would be done by seniors in our office. I said, what's your senior billing rate? They said 1.25 to 150. I said, I guess they're getting 200 now. You have to look at profitability and transpose what it would be in your firm. You have to do that with billing rates. What time and effort, what level staff will it take you to generate those revenues? Another big part of profitability are the tax ramifications of the deal. I don't want to get into a debate with the IRS, but I will tell you it's a very rare time that I have a goodwill transaction. That's 100% goodwill. We're accountants. You can't say to a buyer, pay me over 4 years and deduct it over 15, but don't discount the value of my practice. So the profitability is the profitability of the deal. The fourth variable is the easiest one of them all. It's the duration of the payout period. For small firms, let's say under 1.5, 2 million, most of my payout periods have been 3 to 7 years. Highest by far amount is 5 years. I've had more at 6 than 4, very few at 3 or 7. Larger firms tend to have longer payout periods, more like 6 to 15 years, with the highest percentage of them probably 8, 9, or 10 years. But the fourth variable is the duration of the payout period. So we have money up front, if any, the duration of the guarantee or retention period, the profitability of the deal, then we have the payout period. The fifth variable is the multiple, because the multiple is the effect. The other 4 were the cause. The less money up front, the longer the retention period, the longer the payout period, the more profitable the deal was structured, the higher the valuation. Ask me to pay you faster with more money up front and shorter retention periods and capital gain treatment, I'm going to pay you less. Let's take a working example of that. Let's go back to that $300,000 practice Kathy and I owned. Now, let's say all of you on the phone are buyers and all of you have the ability to absorb this practice with no incremental increases in overhead, an extremely profitable acquisition. If I said to you, pay me 15% of collections for 10 years with no cash down, structured as a consulting agreement, would you do that deal? Now, I know a lot of you will say that's 1.5 times. I'd never do that deal. Let me tell you, as a buyer, I would do that deal yesterday. If I raised the fees 7.5% in years 1 and 2, I basically paid for the whole acquisition. If after 5 years I lost a client, by then I collected 500%, I paid 0.75. I had no risk, no money up front, nothing but gain. And by the way, some of you might be saying, well, Joel, you're not including present value. You know, that's really not 1.5 when it's paid out over 10 years. No, you're right. I'm not including present value. I'm actually ignoring it. I'm ignoring it for 2 reasons. One, I hate present value. Always stunk at it. I get the concept, but I just hated it. But present value is based on an interest factor. If I'm paying you 15% of collections and it includes fee increases in special projects, those fees could go up much better than any interest factor, therefore it doesn't apply. I paid 1.5 because of the deal structure. Now the same seller says to you, hey, I want to be paid out in 5 years, and whatever you do in year 2 locks the purchase price. And I want half goodwill, half consulting. Maybe, depending on where they are in the country, they'd get 1 to 1.25. Now the same seller says, I want to be paid out in 3 years, and whatever they do in the first year locks the purchase price, and I want 20% down, and I want capital gains. I personally could not even get them one time anywhere in this country. Same seller says, I want all cash at closing. I couldn't get them 50 cents on the dollar. So here, 1.5 times I would run to the altar to do the deal. 0.5 I wouldn't touch. How do you start with multiple? Multiple is the effect. And what drives me a little bit batty is how many times people will call me up and they'll say, hey, Joel, we've worked out everything. We just really need someone to draft the agreement and help us plan the transition and the announcement letter. And I'll say, okay, tell me about the terms of the deal. Then there's nothing there about tax treatment. I'll say, well, what's the tax treatment? As the seller's saying goodwill, the buyer's saying consulting. When I ask them about the money up front and the retention period, they've worked out maybe one, not both. You can't negotiate a deal one variable at a time when each variable impacts the other. You need to make a complete presentation. This is the money up front. This is how I'm crediting it back. This is the retention period. This is the tax treatment. Otherwise, you have made an empty offer. What's also interesting that comes up frequently that I get from people is that why aren't I differentiating between an annual client and a business client, or a tax client and a business client? And I get that question a lot, and then I'll ask people why, and they'll say, well, isn't the 1040 client worth less? And I'll say to them, okay, let me ask you a question. Why should they be worth less? And I say to them, on an hourly rate, where do you usually get a better blended rate on? Your accounting work or your tax work? It's always your tax. On an exposure basis, what do you have more exposure on? The accounting work, the audits, or the tax? The audits. Then what do you have better collections on, the tax work? Oh, tax work. So then why do you want to value tax less? And I get two answers. The first one I get is, well, Joel, it comes at a terrible time of year. My answer is, you chose to be a CPA, get over it, never bring that up to me again. The second one's a lucid point. They say, but we have a higher attrition factor in our tax practice than we are in our business clients. Great point. What kind of point is that? It's a point about retention. So if I'm selling you an annually oriented practice and I'm getting paid on a percentage of collections over 4, 5, or 6 years, if I lose a client, I stop paying for it. Therefore, I don't differentiate the value between the two of the tax and the business client. Where the seller says to me, whatever you do in the first year locks the purchase price. On an annually oriented practice, one visit doesn't constitute loyalty. I need more than one visit. So that's where there's going to be a huge reduction in value for a 1040 practice if the retention period isn't long enough. Now, other things you need to factor in. A lot of people will ask me about the furniture, fixtures, and equipment. My answer is, stop, throw it in. Don't be a pig. Now, big deals. We're involved in the BDORG deal. Some of the big deals we do, that's where there is some value placed or at least allocated to furniture, fixtures, and equipment. Very rarely in a small firm is there an additional valuation placed for that stuff. It happens. When it happens, the buyer won't admit it. They're usually just reducing that off the cost of the rest of what they offered. The computer you bought 2 years ago has no value. The desk you bought 15 years ago has no value. What really becomes a big question in retention periods is, does the seller participate in fee increases? Well, almost everybody agrees if it's a service provided in the past by a seller, they'll participate 100% in that fee increase. Sometimes there are people that debate whether the seller should participate in new services. Some people say not at all. Some people say they should, but at a lower rate. I find it challenging to negotiate a deal with someone, as I mentioned earlier, that I lose this client, I pay nothing, I increase this, you did either. I think that if let your problem be you're paying the seller more money than you thought, because if you are, you're making more money. You should get past it. What almost never is included in the purchase price are fee increases from referrals. If you acquired my practice and a client on my client list 2 years later refers you a brand new client, that's the fruit of your labor. Very rarely is that part of consideration in the valuation of a firm. However, I always give every seller a new business incentive program. Many of them may not have been great rainmakers for years because of why? They didn't want to work harder. But if you're going to make it worth their time and give them something strong, like 15% of collections for 3 years, if they want to be an all-commission salesperson for you, let them. This is a wonderful thing. But we've spent so much time on external sales. Let's talk a little bit about internal sales. First of all, they almost always go for less. You never charge a partner what you charge a stranger. And there's a lot of reasons for it. Sweat equity is a big part of it. Maybe when Nikki and I formed our practice 10 years ago, we were doing $1 million. Now we're doing $1.5 million. Isn't she part of the reason? So they almost always go for less. What concerns me is how often they go with no retention period. If your practice is brand loyal, like a Grant Thornton, a BDO, a PwC, they believe their clients are loyal to the brand, to the firm. Most smaller firms are partner loyal. I've done retreats and consulted with many small firms where partners had never met each other's clients. Yet when one partner retires, the compensation would be some certain and fixed based on that. I'm okay with it if you have a 2-year notification and you have a transition plan that you activate, that 2 years before Mo retires, we're going to transition his clients, we're going to do this, we're going to do that. Okay, then that person is going to retire at some certain, I'm okay with that. But 2-year notice, I think it's way too riskful for the firm. Matter of fact, in agreements that I prepare, if the firm, I usually require a minimum 2, sometimes 3 years notice, and the penalty for not giving me that much notice is a retention period. So if I require a 2-year notice and you don't give it to me, I get a 2-year adjustment where fees go down, I pay you less. But one of the biggest trends you'll see in valuing an internal sale is how diminished equity, how diminished the word even means, the value of equity. Smaller firms are still very equity driven. Voting, profit distribution, your retirement, your equity interest times a multiple times the revenues of the firm. Larger firms, for example, I think it's 98 of the top 100, their buyouts based on compensation. Typically they'll say, let's look at an average of your last 3, 4, 5 years income, multiply that traditionally by something between 2 and 3 times comp, usually pay that over 8, 9, 10 years on like a K1, plus capital is usually paid out over half that period of time. So we're starting to see the trend where people are paying partners as opposed to based on equity, based on comp. So the question I get asked a lot is, well, how should we value it? Should we value it on a multiple of revenue or a multiple of comp? It's a long dissertation of the differences. A lot of it has to do with brand loyal versus partner loyal, who's handling, all sorts of things. But let's make something a little simple for you. You make the choice. I'm going to pay you based on a multiple of comp or equity. But how do we come to the final number? Well, here's a work backwards litmus test to make sure your buyout works. It's based on a very simple concept. I have over 160 professionals on the phone with me today. Between you all, I bet you there's been thousands of people that you've helped make a decision on valuing their business. I doubt any of you have ever said to any of your clients, I've done my due diligence, you're going to break even at best, more likely lose money for the next 5 years. It's a great deal, you should do it. Then why would we think we could charge our partners money so that they make less money? What would be in order to pay us out? What would be their motivation to be your successor if they're going to make less money when you retire? And in today's world, where young talent is at such an incredible premium, as firms are begging to build an internal succession team, you've got to make it worthwhile for your partners to be your successor. So here's the litmus test, or the work backwards approach. Let's say there's a partner in a firm and they make $300,000 all in. And let's say we agree that to replace their labor is going to cost the firm $100,000. Well, that leaves $200,000 left for the firm. Now you can start to negotiate. How much of that should the remaining partners get? How much of that should the retiring partner get, and for how long? Because based on that so simple concept, the seller's getting paid for their years of sweat equity, and the buyers are making more money. Very simple concept. So this is part of what you need to think about on an internal sale. But there's other things. Be really careful about how many partners can leave at the same time. In a retreat we did very recently on the West Coast, it was a small 4-partner firm. What we found out were 2 partners were thinking about leaving, both of them, in about 3 years. It's not a financial issue. The buyout was self-funding. But how can we replace 50% of our partners at the same time? So we suggested there should be at least an 18-month period of time between 2 partners leaving, which, by the way, also means if I give you my 2 years' notice, I'm 3 months from leaving and a partner gets hit by the bus, I might have to delay my leaving. Why? Because the firm must survive. A lot of people think, for example, I teach a class and write a lot of partnership agreements. A lot of people think of partnership agreements to protect the partners. I think it's to protect the firm. If the firm doesn't survive, nobody's going to get paid. So some other things to think about in internal succession is watch out for those partners who want to slow down the work but not give up control and income. Causes a lot of animosity. The biggest pet peeve I have when I look at a lot of people's succession planning is how they replace the body, not the role. In a retreat I did in Washington for a firm last year, they was saying how they had 2 partners that were looking to leave over the next 12 months, but they had 2 great managers. They were 2 of the best rainmakers they had. They were looking for a reason to promote them, and this is it. And I asked, who are the 2 partners leaving? One was the audit partner, one was the quality control partner. So I asked them, so you're going to take your 2 best rainmakers, who both, by the way, came from the tax department, and make one of them quality control partner, one of the audit partner? And they looked at me and realized, oh my goodness, we did a body count. We had 2 leaving, we got to bring 2 more in. We didn't replace the role, we replaced the body. A lot of times people aren't thinking when they're valuing the practice and everything else that there's other things involved, like capacity. Do we have the capacity? This partner who's leaving put in 2,400 hours, 1,400 chargeable hours, brought in 15% of the revenues we have in the firm. Can we replace their skill sets in both the technical side, the administration side, the rainmaking side? So valuing it is unbelievably important, but making sure that your process works makes even more sense. For those of you who are looking at internal succession and want more information, we do have some upcoming classes that we go into great length about internal succession readiness assessments and partnership agreements. So generally speaking, let's end on the following note. I'm thinking about buying or selling a practice. The biggest takeaway you should take from today's session is the following. If you don't want to eat lunch with someone, don't sell them your practice. It goes back to, why do you have your clients? It's because of you. If you're not comfortable with your successor, why would you think your clients and staff would be? And remember, your clients like the way your ship is sailing. So you have to find a firm that's going to offer a lot of continuity. If they're going to change everything that the clients are used to, why would we think the clients would stay? Their culture has to make sense, and they have to have the capacity to replace the time that you were putting in, and maybe some of your staff or team that might be slowing down. So they have to be the right people. They have to be able to offer the most continuity, have a similar culture, and the capacity to take on the work. And when valuing it, remember a good deal is a fair deal. The seller should participate in the upside if they're participating in the downside. The seller can't be Santa Claus, but the buyer's not going to do a deal to lose money. And we've got to look at it as a package, not one variable at a time. And we didn't even address the fact that the staff is an important factor, especially if there's some good quality young staff that could actually even add value into the practice valuation. So this is a 2 CPE class crunched into 1 CPE class. I know I was like a 33 record on 78. By the way, if you don't know what that means, you don't have to worry about succession. So hopefully I didn't go too quick, but not only am I going to open this up now to get the last polling question to make sure you get your credit, but I'll also take any questions we had now. And while I'm yapping, sometimes people think of a question a day or 2 or 3 later. Email it to us. We'll still answer it. But let's put up the last polling question. And if I haven't talked everybody's ears off yet, do we have any questions we need to address, Nikki?
We actually have several questions, Joel. I'm not sure if you want me to pick 1 or 2 now or just send them all to you to answer privately. We are at that time limit, and I want to respect folks' time.
Well, let's do the polling question so those that didn't want to stay on the phone don't have to, and we'll still get their credit. And while you're doing that, let me answer 1 or 2, but again, because I went so long, any question I don't answer now, I am running out at an appointment. Tomorrow I will send an email detailed response to everybody. Let's put that polling question up, though.
The polling question is already up, and we have nearly everyone has answered it, but we'll keep it open for another minute. One of the questions,
pick 1 or 2 quick questions. Yeah.
Sure. Are receivables and WIP at the date of sale kept by the seller or go to the buyer?
If you did the work, it's your money. The question becomes when you get it. Many deals that we do have payout periods on receivables. Not all, many. Many will have more about what happens if someone's a delinquent payer. For example, if you have a client that's 6 months behind, you don't want to tell the buyer that the first dollars coming in go to you, the seller, because if that buyer is going to have to work 7, 8 months on the client before they're in cash flow, they may not be as motivated to retain them. You want to motivate your successor firm to retain every client. So working out a payout period for delinquent clients that, for example, half the money comes in, goes to the old debt, half goes to the new debt. We keep that split until the seller's paid off. You got to think a little out of the box on AR and WIP. But in hundreds of deals, I've only been involved in 2 where the buyer purchased the AR and WIP. Now in a merger is different. If we're going to merge together and I'm going to become a partner in your firm, I'll usually have to contribute my AR and WIP to the successor firm, which becomes part of my capital account. But if I'm selling my practice, the AR and WIP is mine. The question is, when do I get it? You think we have time for another, or everybody down?
Well, I'd like to end, if you don't mind, Joel, because once we end, then a brief survey will pop up, and that will give everyone a chance to request a copy of the slides if they'd like. You can also request additional links to articles, which I'd be happy to send. And then keep in mind that there will be an email being sent from me just later this afternoon. That'll have a link to the survey that's required in order to get your CPE credit. If you have any questions at all, you can email me by replying to any of the confirmation emails that you've received.
Well, Nikki, thanks for everything. All of you that had questions unanswered, I promise you they will be answered before the weekend. I will spend all day tomorrow if I need to getting you those answers. Thank you all very much for participating in the session. Nikki, are we ready to shut us down?
We are, yes. Thanks so much, Joel, and thanks, everyone.